So welcome back to another session. Today we'll be looking at financial assets. But what are financial assets? So we say a financial asset is a non-physical asset whose value is derived from a contractual claim, such as a bank deposit, a bond, or stock. So financial assets are usually more liquid than any other assets or any other tangible assets such as commodity or real estate, and they may be traded on the financial markets. So liquid in terms of its ability to be converted to cash in accounts and finance, or you're talking about liquidities, cash, getting actual cash. So financial assets are more liquid than other tangible assets. So financial assets, it includes not only cash, but also assets that can be easily converted to cash. So these includes cash equivalents, short-term investments or marketable securities, and or receivables or accounts receivables. An important point to note is that financial assets are shown in the balance sheet at their current values, right? So, what are some examples of financial assets? You would have seen somewhere before in defining it. Examples include cash, but not only cash, but also marketable securities and or receivables. But let's take another look at what financial assets are and to compare them with what we actually know as our real assets. So, real assets versus financial assets, or real assets, as you would have known, these include or land or factory or equipment, and in essence, it's something that is physically there, right? It's used to produce or to make. Right, so these includes your tractor, your building, whatever sort of equipment and something that you can actually touch. So let's compare that to our financial assets. And in comparing it, we're going to be using the idea that we're a car manufacturer. So yes, we're making cars and we have all our real assets that we need. We have the factory and we have the equipment. So what are the financial assets here? Remember, financial assets are needed. Financial assets include a cash and a cash equivalent. It is actually needed to get the real asset, right? It is also needed to put the real assets that you get to work. So there is no physical thing there for you to touch like land. But how does it derive its power if there's no physical thing to see and to see the value? Its power or worth is in some form of paper or contractual claim. And use the example here of an example of a financial asset, a stock. You can't touch it, you can't touch a stock in a company, right? But you get a piece of paper indicating how much is worth, right? How much power you have, voting power, whether it be in this company. So the financial assets that you will need here to make this car, because you're in the business of making car manufacturing, right? You need financial resources, financial assets to first get these real assets and to put them to work to make this car or the car that you make. Because yes, you can have the real assets, but if you don't have the financial assets to then employ labor, right, you won't be able to carry out your business function. So I hope going through this kind of cleared up any loose ends about what we said. Financial assets are that they are non-physical assets whose value is derived from a contractual claim, such as a bank deposit, a bond, a stock. They're usually more liquid than other tangible assets, and other tangible assets includes commodities, real estate, right? They're traded on the financial markets. They include not only cash, but also those assets that can be easily converted to cash, shown in the balance sheet at their current value, right? And we said examples includes cash, marketable securities, and receivables. But in this video, we're going to be taking a closer look at cash, the financial asset. So what we say cash is the most liquid current asset. Hence, it's listed first in the balance sheet and under current assets. So cash needs to be managed carefully, right? It needs to be carefully managed and controlled as you do for your own cash. So in operating a business, this is also true. So how do we do this? We avoid having excess cash or what we call idle cash alone. And you can think for the myriad of reasons why this is so, right? To ensure that cash is carefully managed, we accurately account for it. So at the end of the day, you do some form of checks and balances to say, okay, this is what I started out with. This is the amount of purchases and sales that has been done for the day. So how much should I accurately have, right? To ensure that it's carefully controlled, you prevent theft and fraud by implementing proper internal control systems in a business. So this is separating who does what, having some form of lockbox, having some form of signature requirement, the checks and balances to keep things in order. And the last thing and last example of carefully managing and controlling cash is ensuring that it is available to deal with immediate transactions or the immediate needs of the business. A lot of persons will look and say, oh, this is ensure that it's managed and controlled, but this is for the efficient and effective use of cash. You don't want to be going about your day-to-day business transaction and you need cash to pay a supplier who notified you that they're coming today with some essential goods, and when it reaches, you don't have actual cash there or any form of equivalent that can be used to make the payment. So we want to ensure that we're making cash available to deal with the immediate transactional needs of the company, right? Point to note, there are two records of a business cash, right? These includes the cash account in the business owns journal ledger. So this is what we've been doing when we see cash in the balance sheet, etc. This is a record of cash in the business. The second record is in the bank account. So your bank account that you have at a bank, and at the end of every month you receive a bank statement. That's another record of cash, and it shows the cash receipts and payments done through the bank, right? But you would agree that there are instances when the cash account in the business journal ledger doesn't match the balance in your bank account or what is reported on your bank statement, right? There might be times when this is so. And because of this, our focus for today is what we'll be doing, because there are times when these two balances won't be in agreement. We have to do something that is called a bank reconciliation, reconciling the two balances, because your cash account that you have at the end of the day, you're going to be, or the end of the month, or whenever time this business deposits this cash, right? They're going to be depositing it in a bank account. So therefore, in your business, you'll have all those records of how much money you deposited, how much money you took out. So that balance that you have in your business general ledger should match what the bank tells you in what they give you in a monthly bank statement. So let's take a greater look at what a bank reconciliation is. So a bank reconciliation, this is a statement that seeks to explain the difference between the bank balance as shown in the general ledger of the business and the bank balance as shown in the bank statement. So remember, I said why you do it? Because those two balance at some point in time. They're not always in agreement for various reasons that we'll look at. So you do this statement to explain that difference, to show why this one is saying this and that one is saying that, and then to bring them on one accord, right? So it shows this as a result of having one, items recorded by the business and not on the bank statement, right? So these are reasons why there might be differences between the balances. Having items that were recorded by the business but not by the bank, right? So in reconciling, you therefore, as long as these are true and legitimate, you will, in your reconciliation, add those to the bank. Another result is having items that are on the bank statement and not recorded by the business, right? So it's vice versa. So the bank can have some items that you either weren't aware about or forgot to include, right? Or you can have some that the bank either hasn't received or it's in its possession, but they're doing some form of review, right? Then you have error made by either the business or the bank. So this can cause you to see a difference. So once you've seen this and you've gone through your bank statement to look at what the bank is saying, you've done all the transactions, you say, okay, this is true, this is not true, this is an error. You notify the bank and you make the adjustments. You could have also made an error in your own business recording, as you've done in the past where we had certain errors or adjustments to make. So you go through again and you see, right? So let's look at, so we said that there were the bank recon, it explains the difference, and the difference is as a result of having either of these three instances. So let's look at the first one, which is items recorded by a business that is not on the bank statement. What are some of these items? So one, this might be an outstanding deposit or a deposit in transit. So this is money deposited by the business but not yet recorded by the bank. So this would be an item that is recorded by the business and not on the bank statement as yet. If it's a deposit in transit, so you, the business, would know that, okay, today I am going to deposit certain such money, amount of money in our bank account. You'd have already accounted for that in your ledgers, right? But for varying reasons, time, the time of day that you did it, how you do it, whatever method, if you use ATM or if you went to a teller, that would determine why it's not recorded by the bank. Another item recorded by the business and not on the bank statement includes unpresented or outstanding checks. So these are checks issued by the business during the period that have not been presented to the bank for payment. So what this is saying is that, okay, you had owed some person's money or you're giving money for whatever reason, right? And you wrote a check, the business wrote a check in the corresponding period that we're doing reconciliation for. However, you have given out this check, but these persons have not yet gone to the bank to cash this amount, right? To cash this amount to remove it from your bank account. So in the business, you would have known that you wrote this check. So you'd have already done your entries and accounted for it. You'd have already reduced your cash in the business, right? So therefore, you'd have already taken care of it on the business side. But because these checks weren't presented to the bank, they're still outstanding. And this is a reason why your bank balance in the business and that you're seeing on the bank statement might not be in agreement. All right. But let's look at items now that might be on the bank statement and are not recorded by the business. What are some of these items? So this includes bank collections or direct credits, right? And these are amounts collected by the bank on behalf of the business. So a customer took some goods and they paid for it. They paid it directly to the bank, or they went to the bank and made that payment. Unless that customer telephoned you or came back to you with the deposit slip, you wouldn't know. So this amount would have already been in your bank account. So it would show up in your bank statement, right? And therefore, unless you were notified, otherwise you would have only known about this once you received your bank statement. The next one is electronic fund transfers, EFTs. So these are paperless transactions that transfer cash to and from bank accounts. And it says here would be reflected on the bank statement. So it's similar, right? It went directly to your bank account unless you're notified about it, and you wouldn't be so too sure. You want to see that it reached, that it cleared, and it is in your bank account, right? So this is one that you'd find on the bank statement that would not necessarily be in the business account already. The next one is bank charges and fees. And this is easy. These are fees charged by the bank for managing your account there. Right. So yes, you are aware that this exists because bank do charge you. But a lot of times you don't remember and you're not going to account for it too early in the month. So you just wait on the bank statement to see. And especially if you have a variable bank rate kind of charge thing, right? You just wait and see, okay, what was the charge this month? And then you update the business records accordingly. The next one is interest and interest. And this is revenue earned on your account. And just like the bank charges you for having your account, you get interest for putting your money there. Whatever rate, whether it be what you like or not like, you get interest. And therefore, as before, similar with the charge, you wouldn't know how much interest you're getting this month, because a lot of interest depends on the amount of money that you have there. And remember, your business, you're putting and taking out money. So at whatever point the bank calculates its interest on whatever money you have, that's what you get. So you just wait and see, okay, how much interest did I get this month? And a lot of time interest, you don't see it on your account monthly. It's done either quarterly, semi-annually, something like that. So you just wait on the bank statement for this. The next one is dishonored checks. So this is something that would be on the bank statement and not recorded in the business. And let's see what dishonored checks are. So these are check payments received by the business, right? From customers or whomever. The business deposits this at the bank. However, the bank on which the checks are drawn failed to honor them, hence the dishonor. So what this is saying is that someone purchased the goods and they paid you via check, but you wouldn't know if this check is real and valid, and if this person has enough money in their account to pay you. So you deposit it at the bank. When they've given you this check, you would have updated your business records. So how am I saying this is on the bank statements and not in business? Don't go too fast. So when they've given you the check, you would have updated the records by increasing cash. But remember, what does the end part? It says the bank dishonors it for varying reasons, right? Maybe the person don't have enough money in their account. Maybe there was a missing signature. Maybe there was an issue with the date. So these are just a few reasons why it might be dishonored, but the bank failed to honor it. So the bank will not update your account because this is not a real check. This is not a legitimate check. So here the bank will not update your account when you think, oh yeah man, my bank balance is going to increase. No. So the bank therefore sends you back this check and say, no, you didn't receive this money. So you need to do two things. One, update your records to remove that cash because they didn't actually receive it. And two, to notify whoever gave you the check and say, hello, you didn't actually pay me, right? So these are just a few of the items that might be on the bank statements and not recorded by the business. So now we know items recorded by the bank statement and not in the business, and in the business and not on the bank statement. And errors are just errors that you just have to look out for at the end. So what's the step? What are the steps in preparing the recon? So first, we're going to be identifying the bank balance. And this is the bank balance as per the bank statement. Two, we're going to be adjusting that bank balance using the items that only appear in the cash book or the business ledgers that were not in the bank statement, because you don't want to double record. So you're going to only be accounting for items that were not there and that should have been there, right? Or in terms of the error, items that are there that shouldn't be there. The next step is, after you've done this, you're going to note your adjusted bank balance figure. The next step, identify the cash account balance, and this is per your business ledger, your bank account balance as per what you have in the business. The same thing, you're going to adjust, but you're going to adjust using items that appeared in or on the bank statement that were not in the ledger. Then note your adjusted cash book balance figure. Point to note that when we say in adjusting the balances, what you're really doing is adding and subtracting from the figures that you've identified. Because remember, these are items that were in one that shouldn't be one, that shouldn't have been in it, or that weren't in it that should be in it. So you have various types. So in the cash book sense, you have the outstanding deposits and you have unpresented checks, right? So to adjust, when you've read the scenario, you'll know, am I adding this or subtracting it, and so forth. Also, both adjusted balance figures, this is accounting, then there must be some form of balancing, right? Both your adjusted bank balance and your adjusted cash book balance must be equal once you've finished, right? And we'll see in our question to follow, so stay tuned for that, why you see that little space between 3 and 4. You can be doing 1 and 4 and going down simultaneously. And that's how we'll be doing it. And how we'll be doing it like that, because it's a full statement, but we'll just be leaving space, right? Leaving some lines to put in whatever comes after. So ensure that at the end of the day, your adjusted bank balance and your adjusted cash book balance, that they're equal. And the last thing that you're doing during the bank reconciliation is to update the business accounting records with the transactions that were not on the bank statement, that were on the bank statement, which belongs in the ledger or the cash book, by journalizing them. So all this is saying, all the adjustments that you would have done on the cash account side in your business ledger, all those adjustments needs to be journalized. And journalizing these items is pretty simple. Why? You already know one side of the transaction, right? We're dealing with what? Cash and bank. So one side of this journal entry is gonna be cash, and the next side is to whatever the adjustment is. How we know whether it's a debit or a credit? Remember, cash is an asset. To increase, you debit. To decrease, you credit. So wherever in our adjustments we're adding, we're knowing that for that entry, it's a debit. And wherever we're subtracting or lessing, for that entry, it's a credit to cash. So these are the steps in preparing the bank reconciliation, right? So this is the end. In our next video, we'll be attempting a bank reconciliation question. If you have any questions, remember to comment in our comment section. You can send us an email or a DM to go through. Remember to like this video, share it with someone who you know might need it, and subscribe to our channel in an effort to receive more videos like this, more tutorials, and to get better understanding of topics. So we'll be doing a little bit more lecture sessions